Hey everyone, welcome back to Corporate Decoder, the place where we crack open the financial books to see what is really cooking. Today, we're diving deep into the latest report from Flaherty and Crumrine Dynamic Preferred and Income Fund Incorporated. And let's just say they've got some interesting things to unpack, especially when it comes to how they make their money and manage risk. So before we get into the nitty-gritty, if you love getting these kinds of insights without the corporate jargon, do us a favor and hit that subscribe button. And hey, we've got a fantastic community on Discord where we break down these reports even further. Link is in the description below. Alright, let's get down to business with Flaherty and Crumrine Dynamic Preferred and Income Fund Incorporated. This report covers their fiscal year ending the 30th of November 2025, and it gives us a really good look at their financial health and strategy. First off, the company is reporting some solid returns. For the last 3 months of their fiscal year, the market price of their shares went up 3.7%, and for the whole year, it jumped a pretty impressive 11.1%. That sounds great, right? But remember, this is just the market price, how the stock is trading. What really matters under the hood is how the actual assets of the fund are doing. When we look at the total return on their net asset value, or NAV, which is the real value of everything the fund owns minus its debts, they saw a 2.7% return in the last quarter and a 9.3% return for the full year. Now, that's still good, but notice how the market price return was higher than the NAV return. This means the market's perception of the fund's value grew faster than its actual holdings did, which can sometimes happen with closed-end funds. It is like the stock got a bit ahead of itself compared to what the fund actually owns. Let's break down what is driving these NAV returns in the last 6 months of the year. The securities they held before considering leverage or expenses contributed 6.1% to the total return. That is the core performance of their investments. Then, the impact of using leverage, which is essentially borrowing money to invest more, added another 2.4%. This leverage is a double-edged sword. It can boost returns when things go well, but it magnifies losses when they don't. And finally, fund expenses like management fees and other operating costs took away 0.6%. When you add all that up, the total return on the NAV for that 6-month period was 7.9%. For the full year, the unleveraged portfolio brought in 8.2%, leverage added 2.2%, and expenses took 1.1%, leading to that 9.3% total NAV return. Now, let's talk about the risk in their portfolio. The report breaks down their investments by credit rating based on Moody's. We see that almost 50% of their managed assets are rated BBB, which is considered investment grade. Another chunk, over 32%, is rated BB, which is on the lower end of investment grade, often called high yield or junk. And about 2% is rated below BB, meaning it is even riskier. Then a good chunk, over 14%, is not rated at all. This tells us they are definitely leaning into higher risk, higher reward investments, typical for a fund focused on preferred and income securities. Looking at their top holdings, we see a heavy concentration in banks and financial institutions. Citigroup Inc., Morgan Stanley, MetLife Inc., and BNP Paribas are all in there. This is right in line with their strategy of focusing on preferred and income, producing securities, which are often issued by financial companies. This concentration, however, also means that if the financial sector faces trouble, the fund could be hit hard. Let's look at some key numbers as of the 30th of November 2025. Their net asset value per S-Hair was $22.8, but the market price was trading at $21.35. This gives us a discount of about 6.36%. This discount is a common feature of closed-end funds, where the stock trades for less than the underlying value. While it can mean you are buying assets at a cheaper price, it also shows that the market isn't valuing the fund at its full NAV, and there is no guarantee that discount will disappear. Now, let's look at the big picture for the year. As of the 30th of November 2025, their total net assets were around $468 million. This is a slight increase from the previous year. The net increase in their assets from operations was about $9 million after accounting for all the income gains and, importantly, the distributions they paid out to shareholders. Diving into the statement of operations, we see their investment income for the year was over $48 million, primarily from dividends and interest. But then their expenses, including a whopping $14.5 million in interest expense from their borrowings, ate up a significant chunk. After all expenses, their net investment income was about $28.9 million. When it comes to selling investments, they actually reported a net realized loss of about $2.4 million for the year. But this was more than offset by a positive change in unrealized appreciation of over $11 million. So, while they sold some assets at a loss, the overall value of the remaining investments went up. Looking at the financial highlights, their total investment return based on net asset value for the year was 9.30%. That is solid, but the total investment return based on market price was even better, at 11.15%. This again highlights that the market price outpaced the NAV growth for the year. Now, let's talk about expenses. The operating expenses, including all that interest from their borrowing, came in at 4.30% of their average net assets. This is a pretty significant expense ratio. When we exclude interest, their operating expenses are a much more reasonable 1.12%. This really shows how much the cost of their leverage impacts their overall expense ratio. Speaking of leverage, their total debt outstanding remained steady at $276.3 million. This is a substantial amount of borrowing. The report also tells us that for every $1,000 of debt, they have about $2,695 in assets to cover it. That is a decent cushion, but it is something to keep an eye on, especially if market conditions turn sour. Let's touch on the core strategy. Their main goal is to get a good total return, with a big focus on earning high current income. They do this by investing at least 80% of their money in preferred and other income, paying securities, often from financial companies. They're not afraid of risk, with a significant portion of their portfolio in below investment grade or unrated securities. Now, this fund isn't without its risks, and they lay them all out. There is market events risk, which is pretty broad and covers things like economic disruptions, geopolitical issues, and even public health crises. They also highlight preferred, contingent capital, and other subordinated securities risk. This means their investments are lower down the totem pole in a company's capital structure, making them riskier. Contingent capital securities, or COCOs, are particularly interesting. These can automatically convert to common stock, or even get written down to zero if the issuer's capital falls below a certain point. That is a serious risk for investors. They also talk about credit risk, concentration risk in the financial sector, interest rate risk, and liquidity risk, meaning some of their holdings might be hard to sell quickly. The day-to-day management of the fund is in the hands of R. Eric Chadwick and Bradford S. Stone. They've been doing this for a while, and their compensation is tied to the firm's overall success and net investment advisory fees. They also manage other accounts. And that brings up potential conflicts of interest concerning how they allocate their time and investment opportunities. While they don't directly get performance bonuses for individual funds, the overall growth of assets under management influences their pay. Here is my take. Flaherty Crumrine Dynamic Preferred and Income Fund Incorporated is playing in a space that offers higher potential returns but comes with higher risks. Their strategy of focusing on preferred and income, producing securities, especially within financials and often with below investment grade ratings, is a deliberate choice to chase that higher income. The double-digit market price return for the year is attractive, but it is important to remember that the NAV growth, while still positive, was more modest. The significant use of leverage boosts potential gains, but also amplifies risk, and that 4.3% expense ratio, heavily influenced by interest costs, is a considerable drag. They're navigating a complex financial landscape, and while they're delivering solid returns for their shareholders right now, investors need to be comfortable with the inherent risks in their investment choices and their use of leverage. The concentration in financials and the inclusion of more speculative securities like COCOs mean this is definitely not a fund for everyone, but for those seeking higher income and willing to accept a higher risk profile, it could be an option. Alright? That is our deep dive into Flaherty Crumrine Dynamic Preferred and Income Fund Incorporated's latest report. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.